Hey everyone, welcome back to Mitchell Markets. Today we are going over two of the four main vertical spreads. We're going to be going over bull call spread and bear put spread, as well as in part two, we are going to be going over the Greeks, how you can manipulate the Greeks to your favor, probability, IV, and other important factors that reflect the outcome of your bull call or bear put spread. So without further ado, let's hop right into the video. Alright guys, let's break this down. What you're looking at here is a bull call spread, also called a debit call spread. This strategy is when you're bullish on a stock, but you don't want to risk a ton of money up front. So here's how it works. I'm buying a $100 call and I'm selling a $105 call. Both of them expire on January 17th, 2026. The $100 call cost $5 and the $105 call brings me in $3. That means I'm paying a net debit of $200 total, and that $200 is my maximum loss on this position. No matter what happens, I can't lose more than the $200. Now, how does this actually make money? When I buy that $100 call, I'm getting the right to buy the stock at $100. If the stock goes up, that call increases in value. The call I sold at $105 limits how much I can make after that point, but it also helps reduce my cost. Instead of spending $500 on a single call, I bring that cost down to just $2 by selling the $105 call against it. So I'm still bullish, but I'm being smarter with my capital and more of a neutral bullish sentiment. Let's talk about the key metrics now. My break-even point is $102. So right here is my break-even. The stock at $102. That's my $100 strike plus the $2 I paid. If the stock finishes below 100, both calls expire worthless and I lose my $200 debit. Between 100 and 105, I start making money dollar for dollar if the stock rises. Once the stock hits $105 or higher, the difference between the two strikes locks in at $5 per share. That's $500 total. But you have to subtract my $200 cost, and my maximum profit is $300. So I can lose $200 at most and make up to $300 at best. That's the full risk to reward profile. And if you look at the chart, you can see the flat line toward the bottom of the chart at $100. So this is my max loss. And the line slopes upward between $100 and $105, and that is where I'm gaining as price moves up. And then it flattens again at 105. That's my capped profit. So I have a capped profit and a capped loss. On the Greek side, delta is around plus 50 in this example, meaning this spread moves about half as much as the stock per share. So delta, green because it works for us, is 0.50. Theta is slightly negative. That's normal for debit spreads, which is time decay. So this is going to theoretically be working against us, but is small. And Vega is also very small, so volatility does not affect this too much, unlike actual call and put positions. In short, a bull call spread is a defined risk, defined reward. You spend less and you're also limiting your losses, as well as still profiting if the stock makes a clean move up into your target range or stays somewhat flat. So my theta at 0.03, slightly negative, basically just means that I'm losing 3 cents per share every single day in profit. but theta does not matter if I am closing above $105. I am already capped. So for a bull call spread or debit spread in general, theta is not going to be a massive player. But it's good to know about. It's good to know about theta, good to know about delta, vega, as well as gamma being 0.05. So that gamma basically tracks delta. Gamma's measuring how fast my delta's changing when the stock moves. It's basically the acceleration of my position, how quickly my option becomes more or less sensitive to the option's movement. In my bull call spread, my gamma is small, around 0.05, which means as the stock goes up, my delta increases slightly, helping me gain momentum. But because I'm both long one call and short another call, the gammas kind of offset each other. So my overall gamma is pretty stable and control. High gamma just means a faster changing delta and more volatility risk. Low gamma, smoother, more predictable movements. So in short, gamma shows how fast your delta reacts to price movements. So for spreads, gamma is not going to be a big deal, but it is something that you should know and learn about, because if I had a higher gamma, it would be affecting how fast my delta is increasing or decreasing. And the delta is really the big swinger in a lot of option trading. So if gamma is making my delta increase quicker and my delta is going to 0.7 in a short period of time as the stock rises, then that means per share I'm gaining 70% of that movement. And it can continuously go up. By each dollar the stock price rises, the gamma is rising, and the gamma is causing the delta to rise at the rate of the gamma. So the Greeks can be a little confusing, and I will do a in-depth video on the Greeks and how to use them and maneuver them on your behalf to help you in your trade. Okay, now this chart right here shows a bear put spread, also called a debit put spread. This is the bearish version of the bull call spread. It's used when you expect the stock to move down, but you still want limited risk and defined reward. So here's what I'm doing. My position is buying a 110 put and selling a 105 put. I'm buying the 110 at $4 and selling the 105 at $2. Both expire on January 17, 2026, and the total cost of the trade is a difference, so the net debit of $200. So that is my maximum possible loss. When you have the 110 put that you're buying for 400 and you're selling the 105 put for 200, your net debit is going to be 200. If the stock stays above 110, both puts expire worthless, and you lose $200. As the stock drops below 110, my long put starts to gain value, and once the price falls below $108, it becomes profitable. The maximum profit happens when it finishes below $105. So this will be your maximum profit. And we'll mark this right here at $105. At that point, the difference between the two strikes is $5, so 500 total. And minus the debit you spent of 200, so that's how you get the 300 profit. Whereas my break even is going to be 108. So at this point, I am breaking even. As the price falls below 108, I am slowly gaining value in this bear put spread. As it rises above 108, I am slowly losing value in this spread until a maximum loss of 200 and a maximum profit of 300. Delta on this position as it is a bearish position has a negative delta of 0.50. So it moves half as much as the stock, but is moving in the opposite direction. Theta is minus 0.03, so it works slightly against me, which theta is time, just like with the debit call spread. Vega is plus 0.04, so rise in volatility helps slightly. So in simple terms, this is a controlled bearish setup. You're paying a small debit up front and you profit if the stock drops moderately without unlimited downside exposure. And it's perfect for traders who think the stock is about to pull back but want to define their risk and avoid overpaying for a single position. Because you're essentially getting this put at a half off with defined risk. Well, not essentially, you are getting the put half off with defined risk. Remember, the bull call spread is making money when the stock is going up. And the bear put spread is making money when the stock is going down. So they are working in different directions, but they have the same defined risk, same defined profit, and a lesser cost compared to buying a flat out call or put option, as well as not having to worry so much about the Greeks in vertical spreads. And they are both using a debit structure